Good afternoon, ladies and gentlemen. Welcome to the second lesson of 2023. So in the previous lesson, we have concluded the October 2022 examination paper, where we have worked through question 3, which addressed the statement of cash flows according to the direct method. Now, today's lesson will focus on the pro forma consolidation journal entries, and the paper that I'm going to use will be the September/November 2021 exam paper. All right. So in the next lesson, we will work through question 2, which addresses the group financial statements. And finally, we will conclude this exam paper by working through question 3, the statement of cash flows. All right. As all of you should know, or at least those of you who are writing the supplementary examination, the exam is due to take place on the 23rd of January at 12 p.m. So please make sure that you prepare very thoroughly for that exam paper. Alright, so without wasting any more time, let's get to our required section. So the required section states that we have to draft the following pro forma consolidation journal entries of the Go Green Limited Group. As I've emphasized in my previous lessons, the group itself is named after the parent. So in question 1, Go Green Limited will be the parent, and I think it was Ron Recycle Limited is deemed to be the subsidiary in this question. All right. So we have determined the names of our parent and subsidiary respectively, and our current year has ended on the 31st of October 2020, which means that it should have started on the 1st of November 2019. Please indicate your current financial year before you start with the question, because as I've also emphasized in my previous lessons, your current financial year will influence your pro forma consolidation journal entries. Okay, let me use a simple example where we have an intergroup sale of a depreciable asset, right? So an asset on which depreciation is written off over a period of time. If that intragroup transaction, so let's say the parent sold machinery to the subsidiary, all right, and the transaction itself occurred in a previous period, then we would need to eliminate the unrealized profit or loss against the retained earnings account of the parent, because the parent made the profit in this transaction. All right, so please indicate your current financial year before you start with the journal entries. And also, before you start with the journal entries, take note of your please note section. As it is normally with a pro forma consolidation journal entry question, we need to indicate clearly to which company each account refers to. And for this question, we do not need to provide journal narrations, which just means that we do not have to describe our journal entries. However, you need to make sure that you understand the journal entry and can describe it if required. All right, we need to show all calculations as with any other question. Round off all amounts to the nearest rand and ignore the taxation effect on unrealized profits and all losses, as well as capital gains tax, as is normally stated in FAC2602. All right, now with this type of question, okay, you need to look for the specific point under additional information that addresses that specific journal entry. So in terms of number A, where we are required to eliminate the unrealized profit included in closing inventory, we need to look under additional information which point addresses the intergroup sale of inventory. All right, because then you would find the information that you need in order to calculate the unrealized profit and eliminate it accordingly. All right, now in this question, intergroup sales of inventory were addressed in point 2, which says the following. So Go Green Limited, which we have determined to be the parent, has always purchased all inventory from Ron Recycle Limited. So what this means is that all of the inventory of the parent is purchased intragroup. So 100% of that value, or of the closing inventory value, will include the unrealized profit that we need to eliminate for consolidation purposes. So it's very important that you take note of this keyword. All right, that being all. All inventory is purchased from the subsidiary. So the entire amount at year end includes unrealized profit that we need to eliminate. In another scenario, it can be that the parent only purchases some of its inventory from the subsidiary. So only a portion of the closing inventory value will include the unrealized profit. All right, but in this case, the entire amount includes unrealized profit, which we need to eliminate when drafting the group's financial statements. Let's read further. Run Recycle sells inventory at a markup of 25% on cost. So we will use the 25% as part of our calculation of the unrealized profit. Now, at the end of the current year, so at the 31st of October 2020, the inventory balances in the accounting records of the two companies were as follows. So here they give you the closing inventory for the parent, which is 940,000, as well as the closing inventory of the subsidiary, which is 860,000. Now, a very important principle that you need to understand here is that we only need to consider the closing inventory of the company that purchases the inventory into group. So in other words, we need to consider the closing inventory of Go Green Limited, because Go Green Limited purchased the inventory into group. So only that company's inventory will include unrealized profit of 25%. So what I'm trying to say here is that the closing inventory value of the subsidiary is irrelevant in this calculation. Okay, we will not use the 860 as part of our calculation. We will use the closing inventory of the parent to calculate the unrealized profit, because this is the value that includes the markup of 25%, and that profit has not been realized outside the group. So therefore it is unrealized, and we need to eliminate that for consolidation purposes. All right, let's just finish reading. So on the 31st of October 2020, financial year end, Go Green Limited had refuse bags amounting to 20,000 Rand on site that were already sold to a customer, but the truck failed to deliver it on time, and the accountant accidentally included this transaction in the inventory count. So the mistake was that the value of 20,000 Rand was considered as part of the inventory count at year end. So in other words, the 20,000 is included in the value of 940,000, but it should not be included because the ownership of that inventory has already passed to a third party. All right, the company does not have control over that inventory anymore, so therefore it should not form part of closing inventory. So what we need to do is we need to remove this 20,000 Rand inventory from the 940,000 as part of our calculation of the unrealized profit in closing inventory. Okay, remember, for journal entry A, we are only required to eliminate the unrealized profit in closing inventory, even though there is sufficient information to suggest that intergroup sales of inventory have always occurred, so since acquisition. So logically, the opening inventory of the parent will also include unrealized profit, but they do not give us enough information to calculate that amount of unrealized profit, because we are not required to eliminate the unrealized profit in opening inventory. We only need to eliminate the profit in closing inventory. All right, let us first calculate that amount. So unrealized profit in closing inventory. Please keep in mind, once again, we are using the closing inventory of the parent, not of the subsidiary, as I've explained previously. So we will take the value given, which was 940,000. Okay, according to additional information point 2, this entire amount includes unrealized profit because all of the parent's inventory is purchased from the subsidiary. Okay, we need to subtract the 20,000 Rand of inventory that has already been sold, so ownership has been transferred, so it should not be included in the closing inventory balance, and then we need to multiply by 25 over 125. All right, we will use 125 because this entire amount already includes unrealized profit of 25%, which we are calculating in this calculation. Right, you should arrive at an answer of 184,000. Okay, so now that we have determined the amount that must be eliminated, we need to consider our journal entry. All right. Now, when we eliminate the unrealized profit in closing inventory, okay, either of the parent or the subsidiary, okay, we need to decrease the actual profit made by the company that sold the inventory into group, okay, and we will do that by increasing their cost of sales account, okay. So we will debit cost of sales of the company that made the unrealized profit of 184,000. In this case, it was One Recycle Limited. Okay, I'm just going to use R Limited, okay, just for short, for One Recycle Limited. Okay, the amount that we have calculated is 184,000. Please make sure that you reference your calculations in the exam on the 23rd of January so that the lecturer or the marker can see where you have calculated a certain amount and how you calculated that amount. So please make sure to reference your calculations clearly. Okay, so we will increase cost of sales for One Recycle Limited, and keep in mind that because this unrealized profit is included in closing inventory, we are removing that unrealized profit from inventory for the parent. So in other words, we will decrease the value of the parent's inventory. So therefore, we will credit inventory for Go Green Limited, and you will credit that by the same amount, 184,000. So this journal entry, we use the correct accounts. We have made reference to the correct companies. Okay, so we have inserted the company next to each account, and we have calculated this amount correctly by taking the 20,000 Rand inventory that has already been sold into consideration. And the 25% unrealized profit markup has been provided in additional information point 2. And we have determined that One Recycle Limited made a profit and that the entire amount of closing inventory for the parent includes unrealized profit because of the fact that all the inventory is purchased from the subsidiary. Okay, so we are done with journal entry A. Now we can move on to journal entry B. Right, now for journal entry B, now this is one of the most popular types of pro forma consolidation journal entries that they ask. Right, you are very likely to come across such a journal entry in the examination on the 23rd of January, where there was an intragroup sale of a depreciable asset. Okay, the journal entry will pardon me. The journal entry will require you to eliminate the unrealized profit or loss. Okay, both are possible, so just make sure that you are able to address both of them. And you also need to eliminate the depreciation associated with the sale of the recycling machine. So from the date of sale up until the end of the current financial year. All right. Now for this question, that transaction is addressed in additional information point 3, which says the following. Go Green Limited sold a plastic recycling machine to One Recycle Limited on the 1st of August 2019. Okay, this is the first piece of information that you need to notice. It's very important that you take note of the date of sale, the 1st of August 2019. If you compare this to your current financial year, which started on the 1st of November 2019, that transaction clearly occurred in the previous financial year. And because of this, we know that we will use the retained earnings account in order to eliminate the unrealized profit. Okay, if it occurred in the current financial year, you will eliminate it against the profit before tax or other income for Go Green Limited. But in this case, it occurred in a previous year or in the previous year. So therefore, we will make use of retained earnings as part of our elimination of the unrealized profit. The machine had a carrying value of 950,000 and was sold at a profit of 30,000 Rand. It is the group's policy to write off depreciation on machinery at 20% per annum according to the reducing balance method. Alright, so let's first address the elimination of the unrealized profit. There is no calculation needed for the profit because it has been provided as 30,000 Rand. And we know that the parent sold the asset to the subsidiary. So the parent made the profit on this transaction. So because of the profit, we need to decrease the actual profit made by Go Green Limited in the previous year, and we will do that by debiting their retained earnings account. Right, so for journal entry B, you will debit retained earnings for Go Green Limited, because that is the company that made the profit in a previous period, and during this elimination we are decreasing the actual profit made by that company by debiting their retained earnings account. The amount of the unrealized profit has been provided as 30,000, and this 30,000 Rand unrealized profit is included in the carrying value of property, plant and equipment for Run Recycle Limited at year end. So therefore we will credit property, plant and equipment, or you can simply credit machinery, which will automatically form part of property, plant and equipment that is disclosed in the statement of financial position for that company. So you can credit property, plant and equipment, or you can credit machinery for Run Recycle Limited, and the amount used is 30,000. Keep in mind that if it was a loss, all right, if a loss was made in the previous period by Go Green Limited, we would need to increase the actual profit made by that company in that period by increasing their retained earnings account. So if that was the case, you would have credited retained earnings for Go Green Limited by 30,000, and you would have debited property, plant and equipment for Run Recycle Limited by the same amount. So in a nutshell, in the case of a loss, so if this is the journal entry, in order to eliminate an unrealized profit, the journal entry for the elimination of an unrealized loss would just be the exact opposite. Right, the amount will also be the same. Okay, but in most of the cases it will be an unrealized profit that was made. Okay, we are not done with journal entry B as yet. We still need to calculate the unrealized depreciation, or the depreciation that is associated with that intragroup sale, and we need to take note of the fact that we are using 20% per annum according to the reducing balance method. All right, and it's very important that you take note of the method that is used, because if you're using reducing balance, you first need to calculate the unrealized depreciation in respect of previous periods. Okay, in this case it would be for the previous year, and then when calculating the current year's unrealized depreciation, you need to subtract the previous year's amount from the unrealized profit when calculating the current year's unrealized depreciation. Okay, let me demonstrate that to you. So for the previous period, it will be from the date of sale, which was the 1st of August 2019, up until the end of the previous year, which would have been on 31st of October 2019. Right? Unrealized depreciation for that period is calculated by taking the unrealized profit of 30,000 Rand. Pardon me. You will multiply that by 20%, because that is the depreciation rate used on machinery, and we are calculating depreciation for 3 months. Okay, August 2019, September 2019, as well as October 2019. Right, you will get an answer or an amount of 1,500. Okay, so for the current year's calculation, because we are using the reducing balance method, we will take the unrealized profit of 30,000, subtract the unrealized depreciation in respect of the previous year, and multiply that by 20%. And you will get an amount of 5,700. So the total unrealized depreciation that we need to eliminate for consolidation purposes is 7,200 Rand, which will just be the sum of these two amounts. Okay. Now, keep in mind that an unrealized profit was made by Go Green Limited. So because of the profit that was made, Run Recycle Limited, the company that purchased the machinery, has provided for too much depreciation in its own financial records. And this excess amount is 7,200, which we have calculated just now. So in other words, we need to decrease the total depreciation that they have provided for by debiting accumulated depreciation for that company. So we will debit accumulated depreciation, which normally has a credit balance, right? So accumulated depreciation for Run Recycle Limited, okay, or double R or LTD, 7,200, and then you will credit 2 accounts in total. Okay, so the first account that we will credit is retained earnings of the company that made the unrealized profit originally, which was Go Green Limited, and the amount credited to retained earnings will be the unrealized depreciation in respect of the previous year, which was 1,500, and then we will credit the depreciation expense of the same company, so that being Go Green Limited. All right, depreciation of Go Green Limited, removing unrealized depreciation of 5,700, which is the current year's amount. Okay, and just a quick note, because the parent made the unrealized profit, this would normally not be included in the analysis of owner's equity. All right, if it was the subsidiary that made the unrealized profit, you would need to show this adjustment in the analysis of owner's equity, which I have also addressed multiple times in my previous lessons. So please have a look at that principle as well. All right. Okay, now let me just show you the correct calculation if we use the straight line method. All right, so if we use the straight line method, the total unrealized depreciation would be calculated immediately from the date of sale, the 1st of August 2019, to the end of the current year, which was the 31st of October 2020. Okay, we will take the unrealized profit of 30,000, multiplied by 20%, and then we are calculating depreciation for a total of 15 months, right? Of which 3 months relate to the previous year. Okay, we have already determined that. The amount that you should arrive at is 7,500. So this is the total unrealized depreciation that should be eliminated for consolidation purposes. But now if we use the straight line method, we will need to split this amount between the previous year and the current year, right? So for the previous year, we will take the amount of 7,500 and multiply this by 3 over 15. We use 3 because, as I've indicated previously, 3 of the 15 months relate to the previous year. And this amount represents unrealized appreciation for 15 months, which is why we use 15 as part of our calculation. We can also just take the unrealized profit of 30,000 multiplied by 20% times 3 over 12. Okay, both methods will give you the same answer of 1,500. Okay, right, and then for the current year, now this is where a different amount is calculated. Okay, because according to the reducing balance method, it is 5,700, but if we use the straight line method, it would be a different amount because of the alternative method that is applied. So the current year's unrealized appreciation in accordance with the straight line method will be calculated by taking the unrealized profit of 30,000 Rand multiplied by 20% times 12 over 12, which will just give you 1, right? Or we can just take the total unrealized appreciation of 7,500, multiply this by 12 over 15. We can also take the amount for the previous year, which is 1,500, times 12 over 3. Right, so all of these will give you the same answer of 6,000 Rand. Right. Okay, keep in mind that only the amounts will be different. Okay, except for the unrealized depreciation in respect of the previous year, that will remain 1,500 Rand, but these two amounts will be different. Okay, if a different depreciation method is applied. All right. Something else I want to say now. Okay. Also, if an unrealized loss was made, it would mean that the subsidiary Run Recycle Limited has provided for insufficient or too little depreciation. So therefore we would need to increase the accumulated depreciation. So this would have been credited by 7,200, and then these two accounts would be debited. Right. That is if a loss was made. Right. Just take note of that as well. Alright, we are done with journal entry B. We have eliminated the unrealized profit of 30,000 and the unrealized depreciation associated with that intergroup sale. Damn it. Great. Let us move on to journal entry C, which requires us to eliminate the intra-group debtor and creditor balances. You will find the information in point 4, which says the following. Now, Run Recycle Limited, the subsidiary, has a debtor balance, so trade and other receivables or just trade receivables, amount of 1.1 million rand, and sells to many customers, including Go Green Limited. So we cannot say that this entire amount is an intragroup item, right? Because it includes other customers' balances as well, right? Not only the balance of Go Green Limited. So we cannot say that the entire amount only relates to Go Green Limited, all right? So that is not the amount that we are required to eliminate, okay? However, Go Green Limited, the parent, has a creditor balance, so trade payables, amount of 450,000 rand, resulting only from purchases from Run Recycle Limited. All right. Now, this just confirms the information that was given in additional information point 2, because in additional information point 2, you have read, or we have determined, that the parent has purchased all of its inventory from the subsidiary. So therefore the subsidiary is the parent's only supplier. Okay, so our conclusion here is that the 450,000 rand only relates to Run Recycle Limited. So this is the amount that is an intragroup item, or that is an intragroup balance that we need to eliminate for consolidation purposes. Okay, that is the elimination of common items. All right, because in the parent's records, we have shown it as a trade payables balance, and in the subsidiaries records, it is part of the trade receivables balance. Okay, so we will eliminate the common items as follows. So for journal entry number C, we will need to debit trade payables, which normally has a credit balance in the parent's records. Okay, so we will debit trade payables for Go Green Limited by 450,000 because the entire amount relates to Run Recycle Limited, which is an intragroup item. Okay, so that is an intragroup balance. Okay, because it only relates to the subsidiary. And then we will credit trade receivables of Run Recycle Limited, because that is the classification of this amount in the subsidiaries records. In the subsidiaries records, it is part of trade receivables, 450,000. Okay, that was not too difficult. It should be 2.5 marks there. Please make sure that you have used the correct companies with the correct accounts. Okay, it's very important that you get this right. Right? And then the last journal entry that we are required to draft is the elimination of the intergroup preference dividends. Okay, and the information is given in additional information point 5, which says that Run Recycle Limited's preference share capital amounts to 700,000. So that is the value of the preference shares issued by the subsidiary. Okay, no preference dividends were in arrears on the 1st of November 2018. And at year end, so on the 31st of October 2020, Run Recycle Limited declared and paid all outstanding preference dividends. All right. Now, in FAC2602, we will treat preference shares as being cumulative. So this means that if we do not declare a preference dividend in the current financial year, the shareholders will not forfeit that dividend. We will need to make provision for that dividend in the next period up until it is eventually paid. Alright, so this means that we have to calculate the preference dividend from the 1st of November 2018 up until the end of this year, which was the 31st of October 2020. So in other words, we need to calculate preference dividends for 2 years instead of 1, because they were preference dividends in arrears at the beginning of this year, the 1st of November 2019. Okay, so let us first determine that amount. So the total preference dividend declared and paid by the subsidiary, which is Run Recycle Limited, will be calculated by taking the value of the preference share capital, which is 700,000, and we need to multiply this by the dividend rate. Now you will find the dividend rate in additional information point 1. Okay, you will see that the group was formed on the 1st of November 2018, so that is the date of acquisition, and on that date the parent acquired a 60% interest in the ordinary shares and a 30% interest in the 8% cumulative preference shares of Run Recycle Limited. Alright, so 8% is the dividend rate that we will use in order to calculate the value of the preference dividend, and as I've indicated, we will multiply by 2 because we are calculating preference dividends from the 1st of November 2018, the date of acquisition, up until the end of this year, which was the 31st of October 2020. Right, you will get an answer of 112,000. So this was the total preference dividends declared and paid by the subsidiary. But keep in mind that a portion of this amount will be intra-group. In other words, there is a portion that was paid to the parent, Go Green Limited, because remember that the parent is a shareholder of the subsidiary, okay, both for ordinary shares as well as preference shares. Okay, and we need to use the parent's percentage interest in the preference share capital in order to calculate the intra-group preference dividend. Okay, so intra-group preference dividend amount is equal to the total of 112,000, and we will multiply this by 30%. Okay, because that is the parent's percentage interest in the preference share capital. So in this calculation, we will not consider the 60% interest in the ordinary share capital because we are dealing with preference dividends. Alright. So the amount paid to the parent was 33,600 Rand. So the non-controlling interest would have received a remaining amount. Okay. Your NCI will take up the remaining 70% of preference share capital. And this is equal to 78,400. So now that we have determined the amounts correctly, we need to draft our journal entry accordingly. Alright. Now, this intra-group preference dividend of 33,600 Rand would have been recorded in the parent's other income line item, okay, or account rather. Okay, it would have been included as part of its other income. Right. So we will debit other income. All the profit before tax, okay, it will give you the same result of Go Green Limited by 33,600. We will debit non-controlling interests. So in the consolidated statement of financial of changes in equity, you will show this as a negative adjustment in the non-controlling interest column. Okay, 78,400, and we will credit preference dividends paid and declared, or declared and paid rather, let's rather put it that way, because you have to declare a dividend before you actually pay it. So preference dividends declared and paid. You could also say dividends declared and paid for Run Recycle Limited. And the amount is 112,000 that we have calculated here. All right. Also, just another note that I would like you to make is that, remember, for the purpose of control, okay, so that to determine whether the parent is a majority shareholder, okay, we need to consider the ordinary share capital. Okay, in Factor 602, the group itself is only formed if the parent has control over the subsidiary, and this is done if the parent is a majority shareholder of the ordinary shares of the subsidiary. Okay, in this case, the parent has a 60% interest in the ordinary shares, which means that the parent has control over the subsidiary because voting rights alone determine control, and each ordinary share carries one vote. So if the parent owns a majority of the ordinary shares, the parent also controls the majority voting rights and therefore has control over the subsidiary. That is the case for Factor 602. All right, so what I'm trying to say here is that the parent's interest in the ordinary share capital for Factor 602 must exceed 50%. Okay, because otherwise the parent will not have control over the subsidiary and therefore the group is not formed. Okay, so it must exceed 50% for the parent for ordinary share capital. However, for preference share capital, it can be any percentage, okay, for the parent, right? Because the preference share capital is not considered in determining control. All right, please make a note of that as well. All right, this then concludes question 1 and therefore this lesson. In the next lesson that I will upload, we will work through question 2, which covers the group financial statements. Again, I will be drafting the entire set. I have also shared a set of suggested solutions for this exam paper on Telegram, so you will find it under files on the group if you want to use that while you are working through these lessons. Alright, ladies and gentlemen, enjoy the rest of your day or evening whenever you are watching this. I will see you next time. Have a great one.